Before we begin our investigation, a quick reminder. All information in this video is for educational purposes only and is not financial advice. What if I told you that there is a financial indicator that is over 3,000 years old? An indicator that cannot be hacked because it is based not on computer algorithms, but on the laws of physics and geology. An indicator that predicted the fall of the Roman Empire, defined the economic might of Spain and Britain, and which today is flashing the loudest signal of a coming financial shift in the last 50 years. You are on New Era Economics. Subscribe to learn more. Our investigation is just getting started. But here's the catch. It's almost never mentioned on the financial news. It's ignored by Wall Street analysts. It's been written out of modern economics textbooks. I'm talking about the gold to silver ratio. On the surface, it's just a number. How many ounces of silver it takes to buy 1 ounce of gold. Today, that number hovers around 75. Sounds boring, right? But as I began my investigation, I realized I wasn't just looking at a chart. I was looking at the oldest and most honest financial compass in human history. For millennia, this compass pointed to the economic true north, the fundamental, underlying value relationship between the planet's two primary monetary metals. But in the 20th century, someone deliberately broke this compass. Its needle was forcibly jammed into a position that benefits the modern financial system, a system built on unbacked money. And today, that needle is beginning to tremble. It is trying to return to its true position. And if, or rather when, it does, it will trigger one of the greatest wealth transfers in modern history. You are on New Era Economics. In this investigation, we are going to decode this forgotten historical code. We will journey back 3,000 years to understand the natural state of this indicator. We will find the crime scene in history where and by whom this code was hacked. And most importantly, we will use math and logic to understand what happens when this ancient law of nature reasserts itself. To understand how far off our compass is today, we must first understand where its true north lies. My investigation began with a simple question. Was there a natural price for silver relative to gold throughout history? The answer I found was staggering. Yes. And it was incredibly stable for millennia. For almost all of written human history, from ancient Egypt and Babylon to the Roman Empire and the Renaissance, the ratio between gold and silver almost always fluctuated in a narrow band, from 8-to-1 to 16-to-1. Why? The answer lies not in magic, but in geology. In the Earth's crust, silver is found roughly 8 to 10 times more often than gold. And for thousands of years, the free market, without government interference, instinctively found a price relationship that reflected this natural scarcity. But it wasn't just about geology. Gold and silver played different, yet complementary roles in the economy. An analogy with modern currency is perfect here. Silver was the small bills and coins of the ancient world. It was the workhorse of commerce. It was rare enough to be money, but accessible enough to be used in daily transactions. A soldier received his salary in silver denarii. A farmer sold his harvest for silver coins. An artisan bought his tools with silver. Its primary value was in its utility and universal acceptance. Gold, on the other hand, was the $100 bill, or more accurately, the bank's bullion bar. It was far too valuable for buying bread or sandals. Its role was different. It was the unit of account for large fortunes and the medium for massive transactions. Kings paid tribute in gold. Empires financed wars with gold. Instead of hauling chests filled with thousands of silver coins, you could carry one small but incredibly valuable gold bar. Its primary value was in its concentration of wealth and portability. These two roles created a perfect harmony. The Roman Empire, at the height of its power, officially set the ratio at 12-to-1. In medieval Europe, it fluctuated around 14-to-1. Even the great Sir Isaac Newton, as Master of England's Royal Mint in 1717, conducted a deep analysis and officially fixed the ratio at 15.5 to 1. Think about that. For 3,000 years, different civilizations, separated by centuries and continents, independently arrived at the same conclusion. 15 ounces of silver equaled 1 ounce of gold. This wasn't a decree. It was a reflection of a natural economic law, grounded in geology and practical use. This harmony was so unshakable, it seemed eternal. But, as my investigation revealed, in the late 19th century, this natural law was deliberately broken. This harmony, this natural law seemed eternal. But in the late 19th century, something happened that would forever change the destiny of silver. The code was hacked. And in studying this period, I discovered that this was no accident, no result of the invisible hand of the market. It was a series of deliberate political decisions. The crime scene can be traced back to 1871. The newly concluded Franco-Prussian War left the new German Empire with a massive war indemnity from France, paid in gold. Armed with this gold, Germany made a fateful decision. It moved to a gold standard, simultaneously dumping its vast silver reserves onto the market. This act triggered a chain reaction across Europe. Other nations, fearing their gold would flow to Germany in exchange for depreciating silver, began to panic and abandon their bimetallic, gold and silver standards to also move on to a pure gold standard. But the decisive blow against silver was struck in the United States. In 1873, a coinage act was passed that effectively ended the free minting of silver dollars. This act went down in history as the crime of 1873. Why a crime? Because with the stroke of a pen, it stripped silver of its monetary status in the world's fastest-growing economy. This was done in the interest of the Eastern banks and creditors, whose assets were primarily in gold, to the detriment of the farmers and workers of the West, who had traditionally used silver. This was the first hacking of the code. Silver was artificially expelled from the monetary system. It began its transformation from the people's money into just another commodity. The ratio, which had held steady at 15 to 1 for centuries, began to climb for the first time in history, to 20 to 1, 30 to 1, 40 to 1. But the compass was finally shattered in the 20th century. In 1944, at the Bretton Woods Conference, a new global financial order was created. The US dollar became the world's reserve currency, and it was pegged to gold. Silver played no official monetary role in this new system. It was definitively relegated to the status of an industrial metal. And after 1971, when President Nixon severed the dollar's final link to gold, the financial world entered a new era, the era of unbacked fiat money. In this new reality, the prices of gold and silver were no longer determined by their physical scarcity or historical role. They became determined on the derivatives exchanges, in the world of paper promises that we investigated last time. And this is the conclusion my investigation led me to. The code didn't break on its own. It was hacked. The historical compass was deliberately broken in a two-step process. First, silver was stripped of its monetary weight in the economy and daily life, debasing it. And then its price was handed over to a paper market that could create the illusion of its abundance. All of this was done so that we would lose our bearings in the new era of unbacked money and forget that a natural, honest balance once existed. So, the historical compass was broken. But how far has its needle deflected from true north today? As I began to analyze the current situation, I encountered a paradox so profound it seems almost absurd. Let's forget history for a moment and just look at today's physical reality. The first fact is the industrial extinction of silver. As we've discussed, Silver is a technological superhero. But this has a downside. Unlike gold, which is almost never consumed and is merely accumulated in vaults, silver is used up and destroyed. Every new technological innovation is another source of silver consumption where it is economically unviable to recycle it for subsequent innovations. The microscopic particles of silver in your old phone, laptop, or solar panel are simply thrown into a landfill with the device. This has led to a second, even more shocking fact that I discovered in the reports of leading analysts. For the first time in human history, the above-ground stockpiles of investment-grade silver, that is, silver in the form of coins and bars available for investors to buy, have become smaller than the above-ground stockpiles of investment gold. Think about that. Nearly all the gold ever mined is still with us, with stockpiles estimated at around 2.5 billion ounces. But the stockpiles of investment silver, by various estimates, are less than 2 billion ounces and continue to shrink due to industrial demand. And here we arrive at the central paradox. We have a metal, silver, that is physically scarcer in investment form than gold, that is consumed annually in vast quantities while gold just sits in vaults. And yet, this metal is 75 times cheaper. How is this possible? This is not market logic. This is not economics. This is the result of a century-long psychological operation that has convinced the world of two myths. Myth number 1. Gold is money, and silver is a commodity. After silver was expelled from the monetary system, central banks and financial elites continued to uphold gold status as the ultimate reserve asset. Silver, meanwhile, was intentionally relegated to the status of an industrial metal, subject to the whims of the business cycle. Myth number 2. There is plenty of silver. This myth is sustained by the giant paper market we've investigated. The ratio of paper claims to real metal in the silver market is many times higher than in the gold market. This illusion of abundance allows its price to be effectively suppressed, hiding the growing physical deficit from plain sight. So, what do we have? The price of gold reflects, albeit with distortions, its role as the primary monetary asset. But the price of silver only reflects the illusion of its abundance on the paper market, completely ignoring the fact that in the real world, it is becoming scarcer every day. Today's 75-to-1 ratio is not a reflection of reality, it is a reflection of a century-long gap between reality and perception. And as history shows, such gaps cannot exist forever. So, we've established that the needle of our historical compass, the gold-to-silver ratio, has severely deviated from its true position. This raises the ultimate question. Will it stay there forever, or will it return? My study of financial market history shows that there is one almost immutable law: mean reversion. What does this mean? It is the tendency of any market metric that has deviated significantly from its long-term historical average to, sooner or later, return to it. A stretched rubber band always wants to snap back. A pendulum that has swung to one extreme always returns through the center to the other side. And the gold-to-silver ratio is the oldest and most stretched pendulum in all of the financial markets. The question is not if it will return, but when, and what the trigger will be. The trigger could be anything: a new debt crisis, a loss of confidence in the dollar, a geopolitical conflict, or simply the moment when the industrial deficit in silver becomes so obvious it can no longer be ignored. When that trigger is pulled, the correction could be swift and violent. Let's conduct a thought experiment and consider a few scenarios of what this reversion to the mean might look like. For our baseline, let's assume a conservative future price for gold of, say, $3,000 per ounce. A return to the 20th century level. If the ratio were to return to just the 40-to-1 level, the price of silver would have to be $75 per ounce, That's more than double today's prices. But what if the ratio returns to its 3,000-year historical norm of 15 to 1? In that case, the price of silver would have to be $200 per ounce. And finally, the most audacious scenario. If the market decides to price silver according to its true geological scarcity in the Earth's crust, roughly an 8 to 1 ratio, the price of silver would have to soar to $375 per ounce. I am not making predictions. I am simply showing you the mathematics based on historical precedent. These numbers may seem fantastic, but they are no more fantastic than today's situation, where a metal that is physically scarcer is 75 times cheaper. History teaches us that when man-made market distortions collide with the immutable laws of nature, nature always wins. The reversion to the mean for the gold-to-silver ratio is not just a possibility. From a historical perspective, it is an inevitability. The greatest anomaly in the financial markets will be corrected, and those who understand this are given the opportunity to prepare for one of the greatest wealth transfers of our generation. And so, our investigation comes to a close. We have journeyed 3,000 years into the past and witnessed an era of harmony, when the ratio between gold and silver was a natural law. We found the crime scene in the late 19th century, where that law was deliberately broken. And we have exposed the modern paradox, in which a metal that has become scarcer in investment form is 75 times cheaper. So, what is the gold-to-silver ratio really? After all this analysis, I've come to believe that it's not just an indicator for traders. It is our most reliable compass, showing the level of distortion and sickness in a modern financial system built on unbacked money. And today, its needle is not just deflected, it is off the charts. It is screaming about the single greatest undervaluation of silver relative to gold in all of recorded history. It is pointing to the widest gap between physical reality and paper perception that we have ever seen. This knowledge, not the daily price fluctuations, is your greatest asset. It allows you to see a clear signal where others see only market noise. It allows you to look at today's artificially low price of silver not as a sign of its weakness, but as a measurement of the tension in a spring that has been coiled to its limit. It transforms frightening volatility into a historic opportunity. History teaches us that you cannot ignore the fundamental laws of physics and economics forever. A stretched rubber band always snaps back. A pendulum always returns to the center. This ancient code is about to begin the process of self-correction. We do not know the exact day or the trigger, but we know the direction in which our compass is pointing. Understanding this is what it means to be prepared. It means looking at the financial world not with the eyes of a speculator, but with the eyes of a historian who sees the great cycles. If this investigation has helped you to see this historical compass, if you want to learn how to read it to better navigate the coming financial storm, subscribe. Together, we will watch its needle.